Joining us now is Annandale Capital Chairman George Seay. George, now I know you're not selling big tech, but you're positioned to take advantage of a potential sell-off. But what about little tech and tech that's like used to be big, but is now seen as kind of risky, like Intel? Intel was the top performer on the Dow today.
Yeah, that's funny. Intel's been a bad performer for over 20 years now. It's been kind of a straight elevator ride down to the basement for Intel shareholders for a long time. And now it's actually a value stock, and some value players are pivoting to Intel and interested in it. We're not super interested in tech right now. We're not adding to positions, but we're not cutting them either. We're kind of maintaining the status quo and holding, and maybe writing some call options on things that have gotten way too far ahead of itself, and looking to pivot a little bit in our exposure to healthcare and energy and finance. We think the financial stocks in particular are really, really cheap. And there was a mini panic earlier this year over the regional bank stocks in particular, and we're looking to take advantage of that.
Well, let's talk about that because we got Schwab coming in the morning. You're interested in the regionals. The KRE had a nice little surge today. Let me see. That was up 1.7%, but it's still at those depressed levels where it dropped back in the spring. How much risk might there still be there, given that the whole necessity of so many regionals is under question? We're expecting consolidation. What's consolidation, if it comes, going to do to the KRE?
Well, that's the right question, John, and it's why you pick KRE instead of picking an individual regional bank like Frost out of San Antonio or Regions out of the South, things like that. You buy an ETF or index that covers a whole lot of them. So if you miss on one of those particular regional banks, the overall move, we think, is going to be up and across the board in terms of the sector. And we've written put options from a strike of 45 all the way down to 30, and we own this KRE outright, as we do own Schwab as well. And we think Schwab may disappoint on their earnings, and it may take them a while to get their footing back, but we really like the price. We think that's a really high-quality franchise, and when you can buy it well below the S&P 500 multiple, you buy it.
Now, you mentioned energy and healthcare also. Is it because you like those?
Yeah, I really like Johnson & Johnson at these levels. I think you're getting that on sale because of a lot of litigation and a slower amount of growth from that stock. And I really like upstream oil and gas. It's so out of favor politically and has gone out of favor again this year as commodity prices have gotten soft. Natural gas has cratered this year. Oil's down a good 30–40% from the Ukrainian conflict peak of last year. And we think this is a great time to establish new positions or build on quality businesses like Oxy or EOG, or in the upstream gas space, EQT or RRC or Antero Resources. So we're adding to all those positions right now as they're out of favor.
Okay. Also want to bring in Keith Lerner from Truist Wealth. Keith, we were just talking about energy and healthcare. George likes them. You don't. Why not?
Yeah, well, great to be with you. Well, that's what makes a market, right? We were big bulls on energy last year, and it got overcrowded. We look a lot at the earnings revisions, and the earning trends for energy continues to weaken. I will say, they are cheap, and if you have a longer time frame, let's say in the next 2 to 4 years, I still think it works. Just in the near term, on our overall, from an earnings revision standpoint and from a technical standpoint, it doesn't appear leadership. And the same thing with healthcare. Healthcare is a sector that's just always challenging. It looks cheap in a slowing economy. You think it would work, and then it's like Charlie Brown, fumbling the football again. So there's areas within healthcare. You're seeing biotech act a little bit better, but we're underweight both those areas. We see better opportunities still in areas like industrials, actually making a new fresh 52-week high. And even though tech has had a big run and we've been expecting a bit of a pause here, we think the earning trends for tech, as far as the revision trends, will continue to outperform. And if that's the case, tech should continue to be leadership into the back half of this year.